Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert and developer Patrick Nelson. Patrick is a real estate investor and developer operating 18 student housing properties at university campuses nationally. He and his team at Nelson Partners believe that well-positioned housing for students near campus can leverage the economic stability of a major university and cater to a demand with less volatility that the macroeconomy has. His strategy is to target the well-located properties within walking distance to growing universities that fit within the company's proprietary buying model. In particular, the company will emphasize value-added opportunities, targeting well-located properties that can be upgraded from extensive renovations with a more contemporary look and feel. The key will be to make cost-effective improvements that students could potentially be willing to pay a higher premium for, helping to raise rents, grow income, and appreciate the property value. And so, guys, with that, it's my honor to welcome my guest for today's show, Patrick Nelson. Patrick, how you doing today?
Great, Kevin. Great to be here. Thanks for that intro. Make me sound better than I am.
Yeah, right. Excited to have you here. Very, very much looking forward to peeling back the layers a little bit, talking about you and your business there at Nelson, and ultimately learning about the student housing business. And so, before we dive into the meat and potatoes, Patrick, maybe what we could do is I'll pass it back to you and give you a few minutes to tell us a little bit more about yourself. Maybe go back in time a little bit and how you found your way into the real estate world, and then ultimately, if there's any gaps or cracks in that bio that I did there, the introduction, please fill them in for us.
Sure. No, I appreciate that. Let me tell you, the fun story is this. So my grandfather and his three brothers, actually four brothers, started Nelson Brothers Construction in Salt Lake City in 1946. So they were entrepreneurs. They were farmers out of Idaho, moved to Salt Lake, started a construction company. My dad grew up in that. He then moved to Southern California in the 70s, got involved in single family housing with the Mission Viejo companies, like the first big planned housing tract in the country, and then got into limited partnerships in the 80s, working for a big company called Balcor, who was owned by Jerry Reinsdorf, who you may know owns the Bulls. And funny story on that, I got an autographed basketball from Michael Jordan. My dad got it for when I was a kid, and he did it on a girl's ball, on a girl's basketball, because he went to the store and bought the wrong one.
Oh, that's funny.
So, but anyway, so I just grew up in real estate, right? My grandfather's my dad. Whenever I'd go to somebody's house, my dad would say, look at these windows. They're too big for the view, or they're not capturing the view of this room, whatever. And then later on, my dad and my stepmom started an interior design business kind of later. And so they did a whole bunch of models for builders and stuff. So I kind of say, I'm like almost like the Mannings in football. They grew up with Archie Manning as their dad as a quarterback. Look, they're not the best athletes in the world, but they're the best quarterbacks because they just know it. So I just grew up in all these different avenues of real estate, from construction to single family and to multifamily. And then in the early 2000s, I found this wonderful industry that nobody had really heard of outside of local mom and pops, was just starting to take off, called student housing. And we saw it immediately with all of our real estate and said, wow, this checks a lot of the boxes and it's really exciting. And now it's come all the way to the point where you probably just saw in the news, like was a few weeks ago, that BlackRock bought ACC for $13 billion. They're the biggest student housing company in the country. So that put us a little bit on the map, got some national news. So that's pretty cool.
Yeah, well, also I appreciate that background there, and so I wasn't aware of that student housing, decades ago wasn't a formalized business model outside the typical dorm. Is that the case?
Yeah, that's the case. I mean, it was literally just owned and run by a million mom and pops.
Yeah,
and that's why you didn't see a lot of nice stuff. And everybody like my age and older talks about, oh, I lived in this hole that was barely standing up, and the reason was because the local landlords didn't have to put anything into it to stay full. And you showed up and you paid rent because you were so close to campus, and you just put up with what you had. Now it's really taken off, and there's all the mom and pops are still there. That's what's great. So there's a wide variety of selection if you're a student, but you can also get the high-end Class A with internet and safety. And you want to say safety, I mean, like we lock the doors down, and it's a lot different than the old stuff where you just had breezeways where anybody could follow you right up to your room or whatever, and vice versa. Now we got cameras, and so there's all those different levels. So it's a really cool industry.
Well, let's talk about the evolution there. From the the first student housing property that you got involved in to where you guys are at today. The projects that you're working on. What does that evolution look like of the student housing model? The actual, the buildings themselves, the interiors, the amenities. Give me like that comparison to what it was to what it is at present.
Sure. So let me back up a little bit more about me. I forgot to mention one more thing. I'm just an entrepreneur at heart. In fact, I got my MBA at Utah State, which nobody really heard of for MBA program, but because they had a program in entrepreneurship 20 something years ago. I graduated in 2000, so 22 years ago. Now everybody has it. But with that mindset, right, and being an entrepreneur, it was perfect in student housing because of what you just said. It was a blossoming industry with all this new innovation and technology. For example, Wi-Fi didn't even exist. Back then, when we first started, we were building plug-in internet, right? And then those became obsolete. So it's constantly changing. It really was just mom and pops, local people in these different markets in these small towns like Logan, Utah, Eugene, Oregon, Lubbock, Texas, pick all these college towns. And it was mostly just run by either alumni or local people that would just build apartment complexes, and very small ones. A lot of them were built very inefficiently. There was plenty of land. And they just built like the bare minimum, a room, a bed, a desk, 2 bathrooms, 4 bedrooms in there, sometimes 5 or 6 bedrooms, and a lot of times people shared rooms back in the day. And so that's all evolved now to modern technology of your own room, your own bathroom. You can have your own studio, full gyms, rooftop pools. There's every single amenity you can think of is you can find at some student housing somewhere in the country. High rises, just world-class stuff. So, you want to spend $3,000-4,000 a month on a room, you can.
And the beautiful thing, most of the time, mom and dad's paying for it, right?
Those properties, mom and dad are paying for it.
Yeah.
But then you got to remember, the majority of college students have one thing in common. You know what that is?
What's that?
They're broke. Just like we were all broke. When I was in college,
Yeah.
I waited tables at Red Lobster. I delivered pizzas at Pizza Hut. I parked cars. I sold shoes at Nordstrom. I did all those things. And but nowadays, the parents are a lot more aware. They've been saving and preparing for college, and so there's a little bit more money. And I have 6 daughters. My oldest one's 15. She's gonna be a sophomore in high school this coming year. My number one concern for her is safety. So if I'm a parent, that's what I care about. I want her to be safe when she's in college and all that. And then obviously number 2 is the experience. And so you can really get the full gamut if you're, and I can give your listeners some advice on what to look for if they're in college or they have kids that are going into college. There's lots of things. So you fire away, ask me the questions, and I'll tell you how to make money in real estate, build cash flow, and enjoy your college experience.
Yeah, I'm going to ask one more question about, back when you got just getting started. It was a very mom and poppy industry. It's, since been, consolidated a certain amount by larger institutional players and what have you. But back then, the opportunity you saw was it based in consolidating the existing kind of mom and poppy, smaller apartment complexes, or did you see the opportunity in that, given there was inefficiencies with the existing product, that you could develop and build something newer and better and more efficient? What was that initial project or projects? What'd they look like?
Oh, Kevin, my brother. So you just asked the home run question. I'm going to give you a word for you and your investors, which you probably know well, right? But if they can remember this word, this is how you make money in real estate, in my opinion. The word is arbitrage. Okay. In the financial markets with modern technology, stock trading in New York or on the Pacific Exchange is the same now, right? You can't buy it cheaper and sell it over here. But in real estate, there's always arbitrage. Even in neighborhoods, you can find where a builder has when they come out with their models and their different properties, and you're looking at an individual house, they don't price them right. And in student housing, it was enormous because there's so many different owners. So you have inefficiencies in management. Let me give you a quick example. A mom and pop has owned a property for 20 plus years. They barely put any money into it. They're just cash flowing, sucking the cash out, and it's been a cash cow for decades for their family, right? But what they don't realize is if they put a few $100,000 in, they could raise rents by $50 to $100, which would create millions of dollars of value on a cap rate basis, right? And so that's one thing. So that's from management issues, from value add, physical value add, taking countertops from Formica, that old stuff, peeling to quartz, to buying land. A lot of people don't realize student housing land is really valuable right next to campus. So I've been land banking over the last 5 to 7 years We own about 9 pieces of land at Sacramento State, Washington State, Idaho State, Utah State, some great places. But arbitrage is the key, where you can find where, and also on the big institutions. So ACC, who I just mentioned, who sold for $13 billion, right? They manage 50,000 beds. Well, when you're that big of a company, there's no way that you can manage every one of your properties super efficiently, right? There's just going to be some where they've left stuff off the table, where the manager hasn't been doing a great job, and you can go and advise something because rents are really a little bit higher or their expenses are too high, and we can lower the expenses, or there's just so many different things. So from the big guys, that's what we try to look for, where guys are too big and spread a little too thin. And then the mom and pops, where they've just made so much money, they don't care about maximizing it because they've owned it for 20 years. There's a few ideas of arbitrage, and I think you can find arbitrage in almost every aspect of real estate, because there is no exchange that they trade on. It's literally you driving the property and look at it.
Yeah, no, absolutely. And so you mentioned some of the markets that you guys are in. You go back through that list again, the target markets that either that you're currently in today, or that are on your radar that you'd like to move into.
So here's what's great about student housing. And this is what we found from the very beginning, like you were asking me about it, is every university and every student housing market is its own microeconomy. Mm-hmm. So take Eugene, Oregon. You asked me about my first property I ever did. It was a $4 million property, okay, which is very small for institutional size and for like 10-to-1 investors. $4 million property that I found on LoopNet, okay? If your investor or your listeners know LoopNet, that's kind of more like the mom and pop, almost for sale by owner type, versus like CoStar or the big real estate listings. And it was listed by a father and son who had just torn down some houses and built it up at University of Oregon in Eugene. And this was right before Chip Kelly became famous and everyone started hearing about Oregon and their speed and running. And so we got on there early. The property was 75 yards to the main retail drag that walked right into campus. So, I mean, I think there was 6 coffee shops before. So we liked Eugene, but not very far away, I think 30 minutes away is Beaverton, Oregon, where Oregon State is. And those two markets can be very different. 2 different types of students. An Oregon State student is different than a University of Oregon student, and the housing is different. And so each one, and then you just go to a neighboring state like Utah with the LDS culture, which I know that's a totally different world. You go up to Montana, where we're at. Montana State and Billings is awesome. They're just booming, but totally different.
Explain real quick the differences of students. So you made a reference there that, from one campus to the next, like the students could, be drastically different in nature. What does that mean, and how does that impact the type of product that you're going to deliver to them?
Such a good question. So, look, in every state, they have like in California, there's the UC system versus the state system, right? Like UC Berkeley and UCLA. And UC Davis and UC Santa Barbara are going to be way different students than Cal State Long Beach or Cal State Fullerton, right? Or Cal State San Marcos or something like that. And same thing up in Oregon there. You've got, Oregon State versus University of Oregon. Well, it's much harder to get into the UC or the Oregon system, the university than the Oregon State. And so those students tend to be higher grade point averages, and they come from more affluent backgrounds. So those guys tend to be able to pay more, and the lease up is sooner. So one thing that's very, very different in student housing than traditional multifamily is you have one lease up period, right? And you have to lease up before all the kids move in. Once they move in, you are stuck with that occupancy, whether it's full or half full or in the middle, for the entire year. Because once school starts, there's really nobody else coming until the next year. Whereas a multifamily, if somebody moves out, you can lease it up right away. Somebody's randomly moving in. So student housing is, it's like Christmas for retailers, right? We have to make all of our money during the spring and summer when we're leasing up. So for us, that's right now. It's our busiest time.
Got it. And so I want to switch gears just a little bit, but really talk about more of a development model. When you guys are actually looking to, you'd mentioned you're land banking for the last 5 to 7 years. You've obviously developed a number of properties from the ground up. When you're looking at a new potential ground up development, how are you making the determination that there is a sufficient demand and ultimately that you'll be able to absorb the entirety of that project during that, small window lease up period?
So that's a great question. And that's probably the biggest risk. Everybody asks you, what's the biggest risk of student housing? Well, now it's if a pandemic comes in and shuts down the university. I never thought of that for 20 years, right? But really the biggest risk outside of the university shutting down is that there's just more beds and more available housing than there are students. So that's part of that microeconomy model. You need to look at the university and its growth projections, okay? So you take a school like Arizona State, where we just sold a property there and made 95% return to the investors because it has, I think, over 80,000 students. And over the last 10 years has grown by 20,000 students on fire. And you look at their board of trustees, they want to get to 100,000 kids. They want to be the biggest in the whole country, right? And so that's huge. Whereas other schools, maybe they don't have those growth projections and they like where they're at. And so you need to look at what the growth is of the school, of their 5-year program. And you need to look at how many beds there are and the availability, the scarcity of land, the availability to build. Like, so for example, take my alma mater, Utah State. We're completing a brand new development there. Well, Utah State is a gorgeous campus, hidden gem, sits up in the mountains. And so the east part of the whole campus backs up to a mountain range, right? And the south side is a big like valley that comes out of the mountains that you can't build on. And so that blocks that. And so really the only student area is about 4 blocks by 10 blocks. It's just west of campus. And they call it the campus residential area. That's very, very limited. So you need to look at all those factors, how close you are, how close you are to campus is number one by far. Location, right? Number 2 is how many beds are out there. So then if you go out to a place like University of Florida or Texas A&M, where there are huge schools, but there is just endless land, right? And there's been tens of thousands of beds built. And so when the builders get too overzealous and overbuild and there's more beds than there are kids, that's where it gets tough. You start giving away the world, concessions, and that's where I think you see some of the, and if you're too far from campus, you can get hurt by somebody else building in front of you. So those are the few of the factors, if that makes sense.
So the comparison you just gave there, or the example, University of Florida, we're actually based down in the Tampa Bay area. My wife went to the UF, and so very familiar with Gainesville and their campus up there, is that there's not as much of a barrier to entry in that marketplace. Because again, you look at it from Google Earth and you see that, you go out 3 miles or 2 miles even from the campus, and there's a good amount of land. And the further out you go, it becomes, thousands upon thousands of acres available that you could potentially build on at some point in time. So whereas maybe some of these other campuses that you're building on, there's a significant barrier to entry where there's very limited land available that's within, a reasonable distance to the campus. Is that correct?
That's exactly right. We try to focus really Rocky Mountains west. And whereas you'll see most of the big headlines and the ACC stuff is all like the Sun Belt, the SEC schools, basically Texas through Florida, where you've got great weather, tons of land, and you can build. And I think even if you go to Gainesville, when you drive along the campus now, it almost looks like Vegas, like with all the hotels. You see all this Class A student housing, and you see some of the most amazing things that the human mind can build down there. It's unbelievable. But it's also a very, very tough market because there's so much stuff built, and you have to, you've really got to compete.
How important is walkability if you're going to be developing a new product, like walkability to, shops, restaurants, nightlife, things of that nature? Is that of incredible importance, or does it just really depend?
Such a good question. Did you read the book before you started asking me these questions?
I didn't know you had a book, so I'm glad I know now. We'll have to let people know about it. You can plug it at the end.
No, it's not my book, but there is one student housing book out there.
Yeah.
So I would say, look, the bars and restaurants are a big deal to college and college kids, but that's secondary to campus because you do that at nights and the weekends and stuff like that. Number one, by far and away, the predictor of success is how close you are to campus. And there's a lot of stats done. You can even look them up on ACC's website and stuff. But look, if you're within, let's just call it 100 to 200 yards, you're always going to be full. If you're less than a quarter of the mile, then you'll be full. If you're less than a half mile, and then even under a mile, depending on the size of the school, you're going to be really good. And then once you get over a mile, then you got to start looking at how big is the school, how much land is there out there. And then there's a lot of other factors, like at University of Arizona, there's 40,000 kids that go there. There's land, but at the same time, it's perfect weather almost from September to May, which is a school season. So people don't mind riding their beach cruisers and their longboards and all that stuff. So you can get away with being a little farther at a place like that versus like Montana State, where it's freezing cold for almost the entire school year, or Colorado or Utah. So I like the West. The reason we're in the Western states is just because there's such little space. Like we're in Bellingham, Washington. We're just getting ready to sell a property up at Western Washington University. You may have never heard of it, but it's like the third biggest, best school in the state. You got, the Huskies, and then you got in Pullman where we actually have land and we have our rehab property there I can talk about. But then you have Western Washington, Division II, but they're awesome. It's a great school. Their women's volleyball is like #1 in the country, but they're up on a hill overlooking the mountain, overlooking the Puget Sound, gorgeous views, but there's nowhere to build. I mean, there's literally nowhere to build. So I think the guys who built it bought it from a church that was there for 30 years and took 3 years to convince them to finally sell. So that scarcity, like at Utah State, I just mentioned, are the type of things that we look for. And in answer to your question, if you are walkable or adjacent to campus, it's like beachfront property. You just can't replace it.
That makes sense. That makes sense. I gathered from your website, and correct me if I'm wrong, but I believe that your property management is vertically integrated. Is that correct?
Yeah, we're a fully vertically integrated company.
Okay.
So we have our own property management company. We've got 160, I think, of the best employees out there. Guys that have been in the industry for over 2 decades that are leading us. And then we have our own construction management to do our rehab, which we haven't talked about. We do a lot of rehab. I love taking properties from like a C to a B-. It's been very, very profitable for us. We talk about that strategy. It's a great small strategy too for listeners who want to do it themselves. Can talk about. And then of course, we have our own concrete company as well, which builds all of our parking garages and our foundations and stuff. And I could talk about that. We really are trying to build parking garages to help students' mental health. Okay, how's that for a leader? We really care about individual students' mental health, which is a big problem for college students. And parking garages I think are really going to help us do that. I can explain that down the road or whenever you want to talk about it.
Yeah, I mean, feel free. We're on that topic. I was going to ask you, just really, we can definitely go there after, but I'd like you to expand upon the parking garages and how that ultimately can help someone's mental health. But what I wanted to ask was, those that are considering maybe buying a student housing investment, if they just are buying 1 or 2, it might not make sense for them to try to build out their own property management firm. And so any advice or suggestions you might have as it relates to finding a well-suited third-party property management company. But maybe let's hit that question after the parking garage topic.
The parking garage topic is special to my heart. So here's one thing that we do that no other student housing does, or that I know of out there. We have our own family counselor. That's what his PhD is in, marriage and family therapy. We have a PhD that's on our staff that is there just to help our students because there's so much mental health issues. It's unbelievable that we're so connected, right, with modern technology and smartphones and Snapchat and all those things. The college kids, they know everything that's going on everywhere, and you can text. Yet the #1 complaints are loneliness and anxiety and being alone. And so if you can believe that college kids go to college, and there's always the athletes and the popular kids but there's so many kids that struggle. So what we've tried to do is in the old model is that you have surface parking and you build like an apartment building and a whole bunch of buildings that look all the same. Like anything from the 70s, 80s, 90s, even early 2000s, that's what you'll see. And you live in a building that looks just like I live in building 4 and you're in building 5 and they all look the same. But the problem is when you're way out in building 5 and the pool and clubhouse is way over at the front of the property, you don't know what's going on. And so you're actually in your individual room just by yourself. And even with technology, it's people are more isolated. So what we're trying to do is go a little more vertical so that we get off of the surface parking, put all the cars in a parking garage, because when you're well located, you hardly use your car once a week, maybe to go to the grocery store or go somewhere for the weekend. And so then when we go up, we build all the amenities in the middle, right? So that everybody looks, you either have great views of the school and surrounding areas, or you look to the middle and you can see all of our volleyball courts and hot tubs and pools. And we even build our weight room and our workout center with all glass that overlooks all of that, so that when you look out your window, it just feels like things are happening and going on, and you're more a part of it. We even try to have parties that are like the no technology parties. So you got to come turn your phone off and actually talk to people.
Throw it in the bucket.
Remember back in the day when we wanted to ask a girl out, you made a phone call, and if she didn't answer, the answering machine picked up, and if you left a message, it was out loud. Everybody heard it.
Yeah.
And if they were there in the room, they all listened to you say, "Hey, Jenny, this is Pat, I'm just
That's
calling.
funny.
Whereas now you text at midnight to 20 people and it's different. So we're trying to bring that back, get people to talk and really connect. And also at the universities along the mental health, almost every university I know, it's 5 to 6 months even just to get in to see a counselor. They offer great counseling, but it's so backed up. So that's why we have our own counselor that we offer. The parents can call, kids can call. Right before COVID, we did what we call the fireside, where he went and spoke to mental health, and we had 20% of the apartment complex showed up.
Wow.
I mean, that is enormous.
Yeah, that is. That's wow. That's huge. Speaking to the parking garage. Number one, that's awesome. I love everything about that. Speaking to the parking garage, something that just came to mind, and I can't recall who I had interviewed within the last couple of years. It was a fairly large, nationally a national multifamily development firm, and there a lot of the new developments, mostly urban infill type locations. As far as their parking garages were concerned, that were there to facilitate the renters of their apartments, they were building those parking garages so that in the future, should there be more of a demand for additional apartment units versus that of parking spaces for cars, as technology moves forward and cars might start driving themselves, or we just don't need cars anymore, whatever happens, they have the ability, and they've designed again that garage so that it doesn't need to be demoed. It ultimately can be easily converted based on ceiling heights and the structural component of it converted into apartment units. Have you guys given consideration to that as you build out parking garages?
Not yet. That's a little bit of ahead of ours. I'd say as far as we're at right now is the modern. We've really looked and examined some of the modern parking garages where they park themselves. Like you go up and you just get out of your car and a machine basically takes it and puts it like parks it for you and then pulls it back up later. And then you can get way more cars into a very smaller area. Right now the rents, just the kids, even the rich kids, I mean, people still are on a budget and all that. So the budgets just aren't there yet to really build that type of stuff. And then mostly when we're that close to campus, we're still about 50 to 60% parking spaces, just because most kids still walk or ride their bike and don't have a car when you're that close. When you get farther away from campus, like a mile or two out, then you got to have all that parking. And then there we tend to have enough space that we can do more surface or the parking garages and stuff like that.
So, I always consider student housing as a kind of a subsector of multifamily. And so, we've had many guests on the show, multifamily investment experts. And so, probably, not hundreds, but definitely quite a few over the years that we've been doing this show. And so a lot of the listeners are very familiar with multifamily. Multifamily's kind of been the darling child over the last decade. And so even if you don't try to pay attention to multifamily's still in your face, it seems. And so, that's a pretty straightforward business model. Student housing has a number of unique nuances that are associated with the operations aspect that are drastically different than that of a traditional multifamily. So maybe speak to some of those major differences, again, comparing a traditional multifamily to that of a student housing.
So there are some major differences. I would say the best way to describe student housing is it's a specialized subset of multifamily, right? But you have to be an expert. And we've had a lot of multifamily people say, oh, great, students, no problem. They try to come into student housing and they just don't do well. You have to get a professional management company. I can talk about that too. You asked me some questions about that. I'll bring that back up. But this is a really good, what's the word I'm looking for? Example that I like to use. Okay, so I'm a very okay longboard surfer here in San Clemente. Okay, I can paddle out, and when it's 2 to 3 feet, I can get up and ride, and I'm okay and all that, right? And I have fun. I love being out there, the sunset, the water, it's great. But if I go to Hawaii, I ain't riding the 10-foot waves. I'm not even going out in the water, right? I'm not even going out there. But if you have a big wave surfer in Hawaii, they can certainly come ride the waves I can all day long, okay? And that's kind of how student housing is. We're more like the big wave surfer in that we have a very, very urgent and strategic leasing time. We have to lease up. If we don't lease up before school moves in, okay, or before school starts, then we're stuck. We can't make our payments. I mean, we can't pay our loans. We can't pay our payroll. that's when you see, and you have to go a whole year. So you have to be essentially prepared financially to be able to go essentially a whole school year if something drastic happens, that you can cover everything. And that's what's so difficult. And then at the same time, you don't have families, there's no kids. So you also don't get people that move in and stay there for 3 or 4 years, maybe once in a while. But really the students will come in their sophomore year, the freshmen, and this to all their listeners, I advise that all freshmen live in dorms. It's just way better. All the studies show that you do better, higher grades, lower dropouts, because you meet your peer group and establish friends that you're going to go all 4 years. But then after the dorms, you come out and live with us. But then even then, kids want to move around. They want to change their roommates. So every year we average about 65 to 70% turnover. Okay, a good year is 60%. So that means every year we've got to, and heaven forbid, sometimes you have a whole bunch of seniors or something like that, and you have a 75% turnover. So you've got to lease up 60 to 75% of your building. In really, most markets are done by June. Just because, once you get into June or July, there's not very many kids. Most kids have signed ahead of time, because the parents want them to have a place to live already. They don't want to show up and be like, where are you going to live? So you have to understand that. And then marketing to kids, what I call them kids, college kids, is a lot different than multifamily. And putting up balloons and having open houses and stuff like that. It's primarily online, and your online marketing has to be the modern technology. You have to respond super fast, and you have to create a great reputation of safety and kids living there, and parents, and it honestly would be like me trying to paddle out, like a multifamily guy trying to come into student housing would be like me trying to paddle out in Hawaii, where I don't know the swells and the currents and the big waves and sharks, and I would just get crushed. And that happens to a lot of multifamily people.
So let's talk about the property management side of it then. As far as, again, I'm a small time investor. I'm looking to buy a student housing property. Again, we whatever size it might, maybe it's a 40 unit or 40 bed student housing property. Obviously, I'm not going to go build my own vertically integrated property management company. It just wouldn't make sense at that scale. And so I'm going to be looking for a qualified third-party property management firm. What's some advice that you might give to that investor as far as how they pick the good from the bad as they're going through and interviewing different property management companies that specialize in this space?
That's a really great question. And the property manager is going to make or break your success, right? They're going to lease you up. They're going to push rents. If you have a great one, you're going to make money. If you have a bad one, you're not. And here's the answer to that is you need someone who's going to care about your property. Okay. So for example, if you have a small property and you go find somebody that has 4,000 beds in the market and they're like, oh yeah, we control everything. Well, they're going to cater a lot of times to their bigger clients that have 2,000 beds with them. And if you have one little property, they're not going to focus on you. But in almost every student housing college town, there are small companies where there's little entrepreneurs, even ex-students, local people that live in the town that, only have 4, 5, 6, 10 properties, and they will love your stuff. So the best thing to do is go find your competitors, find out which ones when you walk in the door, and just go take a tour like it's you with your son or daughter, and find out who treats you well, who follows up with you, and then find out who those property companies are. And then I would call them and interview them. And then don't be afraid to change. If you get a property manager that comes in and they're just not doing well and they're not leasing up for you or pushing your rents, or they're not actively engaged in your property, then look for someone else. There's a million small little entrepreneurs out there. That's the number one thing I would say. Find someone small that cares about you. On a side note from that, one of the biggest mistakes that a lot of parents do is they go, oh, I'm going to go buy this condo because my kid's going to go there for 4 years and they're going to live there the whole time and I'm going to make a bunch of money. Well, condos in college towns don't tend to appreciate in value like they do in California or Florida or some of these big markets, because they're based on the local economy and the revenue. And what happens is their kid goes and lives there, maybe their first or second year, and then they're like, I want to move. And they don't want to be a manager and they don't want to run it and all that. And then now the parents stuck there with this condo trying to lease it out, and they throw it on the market. Did it really change in value 2 or 3 years? You got to make up for the commission and all that. So if you're going to do that, you need to find something that you believe you can rent out, right? Even with or without your student. That's number one. And there are lots of people that buy townhouses and condos if they're really well located. And you can just have a student that lives there, offer them a little off rent, and they're great marketers. if you only have 4 or 8 beds or 4 or 8 rooms, it can be a great investment, but make sure you buy it based on the revenue income, right? Which means you got to put enough down that you're cash flowing and not really the appreciation,
Yeah.
because you just don't see a ton of appreciation in condos like you do in other places. And that's a big mistake. People get stuck, they're trying to sell it, and the commissions and the headache for 4 beds for their son or daughter just didn't work out well. That's one thing I would recommend.
Good deal. One thing that I kind of missed and began wanted to ask you about, and someone's going to back up here a little bit as far as the last 2 years. Right now, I think we can finally say we're somewhat in a post-COVID world. I mean, I know that it's still out there, it's still floating around, different variants, what have you. But ultimately, the country's back, open again, it's operating, and I don't think there's any restrictions left over. There might be in some small parts of the country or different various states or what have you, but I think for the most part we're back open now. And so there's been a number of asset classes that have done fairly well through COVID. Again, multifamily, traditional multifamily was one that just seemed to just boom during the COVID period of time. And no one knew that back in March of 2020. Everyone, just like us, we wondered whether or not people were going to pay their rent, and they, the majority of them did pay their rent. But hospitality got its butt kicked. And it's still, unless it was in a beach town or a tourism location, desirable tourism location, it might still be struggling today with less and less business travelers, going to meet their clients versus just doing it via Zoom. And so, student housing, lots of college campuses shut down for at least a year, some much longer than that. And so how did you guys, what changes did you make to your business model, and how did you guys ultimately make it through those challenging 2 years? I mean, and again, I'm sure you probably had different experiences based on the campus where your property was, but just generally speaking, talk to me about that period of time and how you made it out the other side.
I mean, the word is just brutal. It was brutal. Every single university and college in the entire country shut down in a matter of weeks. And then the government, the CDC, whatever, passed laws that said we can't evict, we can't even collect rent necessarily. But they didn't give us a break, meaning they didn't give us mandatory breaks from our lenders and from taxes and insurance and all of those bills that we still had to pay. So it was just brutal. I will say this though, for the most part, most people and parents, 85% of them still paid their rent. They were stand-up people. They did the right thing. And then I'd say, 5 to 10% just couldn't. The financial hardships on them, they just couldn't, and we totally understand that. And then there's the 10% in the middle that just took advantage, didn't pay, they left, or they stayed there, whatever. We had about 3 properties at the time. We had about 21 properties under management, or 22. About 3 properties really struggled. I'll tell you, the ones that struggled were the ones that were in major metro areas, like our Houston property. We actually gave one back to the bank. I never missed a payment, never had an investor lose money, and we had one property go back to the bank. It had some unusual circumstances as well, in that there was a bayou between us and University of Houston, and they shut the bridge over the bayou down. So we went from being 300 yards from campus to over a mile away. That's the only one that really we gave back, and Fannie just wouldn't work with us on it. And it was just a really, really hard situation. But for the most part, most of my properties stayed about 80% economic occupancy, which was enough to cover all of our expenses and pay everything. But look, we were first and foremost, you got to remember, we were worried about safety. We didn't know we were going to have students dying, in our properties at first. So we thought, we're seeing all these videos in New York where the hospitals are overflowing, and what if the local hospitals, there's only one hospital and all the kids have COVID? And fortunately, the students just didn't get sick. I don't even know one college kid out of the 600 or 700 reports we had of cases even went to the hospital. I mean, they just didn't get sick. It didn't affect them. They were jonesing to get back, get out of their house and get out there. The good news for us, though, is over 600,000 students took a deferral across college campuses. And so that's going to be pent-up demand for years to come. I think that's why you saw Blackstone buy ACC. We're seeing our best leasing coming back right now. So it's all roaring back. And with that, I think the stability and power of the economic anchors of the universities that's backed up student housing is in full-fledged strength again. And so we're super happy about that. But yeah, for about a year and a half with the hybrid program, it was brutal.
I know you said that the leasing portion typically wraps up by June, and so based on the data that you have at hand, are you seeing that we literally are back to pre-COVID levels, or that your properties, as far as overall demand and lease up, are back to pre-COVID
It's
numbers?
stronger. Right now, it's
Okay.
stronger because of the demand. There's way more kids coming
Great.
back. I mean, look, there's a few schools that they limit the number of people they take in, so it's still the same. But for the schools that are open enrollment, the international students, they're 25% of our residents. They were shut down completely, right? And so now they're back, and there's just so much demand. There's a couple of smaller schools like Dixie State in Southern Utah is now called Utah Tech. They're a Division I school. They don't even have one house available. Utah State, the entire market is full. We're trying to get ours open. And there's just, the demand is really strong and really robust. And so that part is really, really exciting. And by the way, we haven't talked about it, but just want to throw this out there. I can talk to you about the advantages of the cash flow and some of the massive advantages of student housing has because that's your whole program, right? Is building cash flow.
Absolutely.
We haven't talked about the economics, but in terms of the pandemic, man, 2020 was a brutal year, and 2021 even, because they still stayed as a hybrid. But now this year we're finally back up, and I think next year will be our best year probably of all time.
Okay, good deal. And I know that we're kind of abutting the time frame that we had, and so maybe we have to do a part 2 of this. I think we have a good bit more to talk about. But there's one last question. As we wrap up this segment, I think we will definitely schedule a second part to this so that we can again hit some of the more detailed areas around cash flow and the different economics of student housing. The one question I love to always ask our guests that we have on the show, and you've been at this now for multiple decades, very similar to that of a lot of the other guests we have on the show. They've been doing deals, through multiple different cycles. And there's always that one deal or more than one deal. If you've done enough deals, there's always that one that just seems to have added more stress to your life than what you expected. It gave you more gray hairs, sleepless nights, what have you. It was the one that you regretted, you couldn't wait to get rid of. And again, I want to talk about outside of COVID though, because I know COVID just seemed to be all lumped together. It made everything challenging. So outside of COVID, what was that one property that comes to mind again that added just a heightened level of stress to your world? And so what were the challenges associated with it? How'd you make it through? And then I guess what would you have done differently, or what lessons did you learn as a result of that particular property?
Such a good question. We've had 2 properties probably that come to mind. One's at TCU in Fort Worth, and the other one is the only other property we've ever given back to the bank was at Ole Miss. And they were earlier in our career when student housing was still, budding and coming up, and there wasn't all the builders and everybody. And it comes down to the same thing. We weren't protected by barriers to entry. And so like at Ole Miss, the university was growing, but growing slightly. Then they got put on football. They got put on, for recruiting violations and all that stuff. And so literally the population started going down by a couple thousand, and we were a mile from campus. And then there was 2,000 or 3,000 new beds that were built with the population going down. This is all pre-COVID. And so there was just way too many beds. And so you're right, 2 or 3 of our properties gave us all the gray hair in leasing, whereas 90% of our properties just lease up. So if I could go back and I just follow my same exact, and we built our models, gotten better and better, but our barriers to entry, the proximity to campus, the growth, everything I talked about at the beginning, we let a couple of those go because it was really hard to buy properties back then because nobody sells student housing. They love the cash flow and the stability. Yeah. And so we just got a little aggressive on 2 of those properties. But outside of that, our cash flow is great. We have a fund right now for our value add. I didn't get to talk about, it's paying 13%. Also, most of our stuff is 1031 eligible for investors, where they can defer all of their taxes and make cash flow. And then here's one other great thing about student housing. The land value is usually less than 10%, around 5% in the small towns. So you can depreciate usually over 100% of your cash flow. So if I get you a coupon of 6 or 7%, you put 6 or 7% in your pocket. Whereas if you're in triple net or commercial, and you depreciate over 39 years, it's 40% land value and all that, or even multifamily, big acres of land in like Florida and stuff, you shelter maybe 50% of it. So then you take home maybe 3 or 4%, which is 50% less. So when you look at student housing and the cash you put in your pocket, and then you can do a 1031 when you sell it and pay 0 taxes, capital gains or recapture taxes. Yeah. It's the greatest wealth building machine I've ever seen, I think, in the history of the world.
So given that, Patrick, for those that have an interest in learning more about you and your company and your different offerings, where's the best place to find you?
Just go to nelsonpartners.com. It's super easy. Our Nelson Partners 1031 exchange. We have a couple properties out. We're coming out right now with a great one in Salt Lake City near the University of Utah. It's just a home run of a property. It's 100% full even through COVID. So we've got some great opportunities there. Great, lots of ways to invest. If anybody's looking wants to talk about an individual school and they want to invest, I'm happy to talk to them. I love talking to people. We're a first name basis company, Kevin. That's the best part about us. We just don't have a ton of investors. We have no partners, even though we're called Nelson Partners, no institution. So we don't have a board. So we're really, really low key. And you can go to, oh, by the way, you can go to any one of my properties across the country, unannounced, just show up, take a tour. If we don't do good, give me feedback. But let me know how the manager is doing. And let me know that if one of your kids lives in one of our properties, let me know how they're doing. We love it.
Fantastic. Well, Patrick, it's been a lot of fun having you here, my friend. Appreciate you spending time with us today, and it's been great learning about your company. And like I said, we'll figure out that part two, because I think there's a good bit more that we need to cover that we didn't have time to today. But appreciate you coming on, my friend.
Kevin, you're one of the most knowledgeable hosts I've ever worked with. I've been on a lot of shows around the country, and people should really listen. You know what you're talking about in real estate, brother. Thanks for having me on.
I appreciate that. Thank you, Patrick. And guys, thank you for joining us here today. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.